there, this is Liz Dysart and Stuart Crawford with the Crawford Team at VIP Mortgage, and we are here to give our friends at my home group a lending update and really hit all of the things that real estate agents need to know in order to be able to close transactions on time with all the changes that have happened due to COVID-19. So as of today, April 20th, here are the things we really think you need to know. And Stuart Crawford is a VP at VIP Mortgage, and he's going to go over each of these topics for you. So we're going to cover quickly forbearance, the major changes to lending products and programs, what's happening with rates, and lastly, the big question, where is lending headed? So here are some headlines that we've been seeing. Some of these incite a lot of fear in people. So we want to cover these and say what's true and what's not. We're not going to touch on each of these, but if you have any questions, we will definitely clear it up by the end of the video. So stay tuned. So the first topic Stuart's going to talk about is what is forbearance?
Hey, MHG family, thanks for listening to us today. We're going to do our best to get through this as quick as we can because your time is valuable. You're hearing a lot about mortgage forbearance, and what we need to understand very quickly about it is it's not loan forgiveness. It's absolutely something where the borrower or consumer is going to have to make those payments back. So it is essentially a loan servicer like Wells Fargo saying, we're going to allow you to not make payments for a specific period of time, but then you'll pay them back based on whatever directives they give. So some lenders are saying you'll have to make all the payments back at once. So let's say an example that they let you miss, 6 payments, then they're going to have you make all 6 payments at once. And as you can imagine, that's probably a scary prospect for a lot of homeowners. Other options are going to be tacking it onto their mortgage payment over a specific period of time, like a repayment plan. I think that's going to be a lot more popular with most servicers. So the interesting thing about this is it is based off the honor system. So what we're being told is there isn't going to be anything specific about having to prove you're in a financial hardship to be able to get a forbearance request approved. So if you contact your servicer and ask for this, likely they're going to give it to you. One thing we have to be really clear on is as mortgage companies, we don't give forbearance advice. So if anybody's asking you about this, you really need to direct them back to their loan servicer, which is who they make their payments to. And they're going to give them what their current options are for forbearance. And I can tell you that a lot's changed in the last few weeks. And now when we start going to all of these big companies' websites, they've all got explanations of their forbearance, how to apply for it, et cetera, et cetera. So it's pretty the information is now becoming easier to get, whereas 2 weeks ago this conversation was a lot more of a gray area. One other thing that's important to note on forbearance, and I think this is going to play into a lot of the other topics we're going to talk about, is it is a scary prospect that we're going to allow people to do this. Not that we shouldn't be supporting the American homeowner, but from a standpoint of if you don't have to prove that you're losing your job or getting furloughed, and we're going to open this up to everybody, it can create a major stress on the financial system that, quite frankly, we're not prepared to take. And to give you just one piece of information, the head of the Federal Housing Finance Agency, okay, who essentially creates a lot of the rules and direction for the government-backed enterprises like Fannie Mae and Freddie Mac that you've heard of. Mark Calabria, he came out and predicted that by the end of May, there would be 1 million homeowners in forbearance. We're now midway through April, and that number's almost hit 3 million. So it's already triple what they think in not even the amount of time that they forecasted. So that just shows you, that's proof of what I'm saying, which is this could be a very big snowball rolling downhill that could have bigger impacts down the road.
Absolutely. And as Stuart said, we really encourage you guys not to advise your clients on whether or not they should take advantage of forbearance, but instead just have information available to them if they have questions. We're going to include some great links to some CFPB resources designed for consumers to answer some of these questions for them. So we'll include those with this video as well. Next topic is what's going on with changes to products and programs. And this has probably been the most confusing part for you guys, as a lot of our partners have reached out as they've heard that certain things have completely gone away. And as what Stuart will tell you is that a lot of individual lenders have made changes to their guidelines, but that doesn't mean it is a widespread industry change. So he's going to talk about those for each of these specific product types and how what we can expect now and maybe going forward.
Yeah, and this is, this is a huge topic. And just to echo what Liz just said, and this is really important, we're speaking to you guys as just mortgage professionals that live and breathe in this industry, not specifically as VIP Mortgage or a specific mortgage company. So we're trying to educate you just on broader, more general things that are happening. And each lender might be a little bit different on what they're allowing or not allowing. So it's important that you dive in deep with where you have that relationship to ask the right questions. But these are going to be these are going to be the case with most places. So we feel like it's relative information that will help you understand what's happening out there. So I'm going to hit all these topics real quick, okay? First one is FHA, VA, what we would call government loans. The big change really is anything that's deemed a high-risk product, the liquidity for those has really left the market. And liquidity, sometimes that's a fancy word that it's hard for us to grasp when it comes to a conversation like this. And all that really means is there isn't demand. There aren't buyers out in the secondary markets that want to take on or back these types of loans. And there's a lot of reasons for that. One, of course, being the high risk nature of them and what could happen with these loans if people are going to be in forbearance and then they can't make the payments later. And then you it's a domino effect, right? And then you start getting into, well, if you're not going to make the payments ever, and now you're really in trouble. Now you're making late payments. Now it's a derogatory. Now we're going to come after you and foreclose on your house. And, of course, I'm giving you the doom and gloom part of it, but that's where an investor pulls back and says, these things are getting a little too risky for me. I'm just not willing to invest in this right now. So that's why there's no liquidity for these types of products. And this is going to be true for a lot of the things we're about to talk about. So the big change with government loans is really the lower FICO score product. Generally speaking, most lenders have allowed you to go down to a 580 FICO score on that type of loan. Most lenders are making changes to not allow to go below 640, okay? So that's important to be aware of. The second one are jumbo loans. Jumbo loans, we've seen a lot of product changes very quickly, and they are tightening up for the same reason. Jumbo loans are risky products because they're bigger loan sizes. So if they were to default, it's a much bigger problem, so to speak, for the person holding on to that piece of paper, because it's a lot bigger of a dollar amount. And in the mortgage business, what a lot of people don't realize for good reason, because unless you're deep in this for a living, you wouldn't know this. As a mortgage company, when we buy and sell loans, and let's say VIP Mortgage sells a loan off to Wells Fargo Bank, there are things in place that if that loan does not perform, or what we have, what we call, an early payment default. So someone gets that loan, the new borrower, and all of a sudden they can't make payments for a few months. There are cases where Wells Fargo in that scenario could call VIP Mortgage and make us buy that loan back, and then we have to write a big check. And you can imagine that that's not something that is part of the business model for a lot of mortgage companies. So those are other further sort of technical reasons on why lenders are tightening on these products, because they don't want to run the risk of not being able to successfully sell them, or they can sell them, but then there's an issue later and they have to buy them back. So because of those things, we've seen some jumbo products kind of leave the market. The biggest one probably is the low down payment. A 10% down jumbo loan has been a really popular product for years. And most of the one loan jumbo loans for 10% down, so a 90% loan to value jumbo loan, have left the market. Now, the good news is there's still ways to restructure those deals with a first mortgage and a line of credit, which lenders are successfully doing. And that makes sense on a lot of those deals, but not all of them. So that's a big change. As far as the qualifying changes, which are also fairly significant, some of these lenders are requiring higher credit scores. They're requiring more in reserves. So a reserve requirement for a jumbo loan, what that means is they want you to have a certain amount of mortgage payments in the bank above and beyond your down payment and closing costs before they close on that mortgage. So simple example, if the new mortgage payment's $1,000 a month on the house they're buying, and there's a 6-month reserve requirement, we need to show $6,000 in the bank above and beyond down payment and closing costs to qualify them. Those reserve requirements have gone up on a lot of these programs because these lenders are trying to just, what are they trying to do here, guys? They're trying to quote unquote clean up their portfolios and make them as pretty as they can and as low risk as they can to protect themselves. Same thing with debt to income ratios. They want debt to income ratios to now be slightly lower than what's previously been allowed. So a lot of changes in the jumbo arena. And again, just something that if you have questions on it, you want to reach out to your lender and ask specific questions so you know what can and can't be done. The non-QM topic, which is next, stands for a non-qualified mortgage, which is really what we call an out-of-the-box mortgage. So your standard vanilla loans fit in this little box we call the qualified mortgage box or QM box. Non-QM would be an example of, they're only a year outside of foreclosure, or they are doing a bank statement program because they're self-employed and they can't qualify with how they report their income on their taxes. A lot of you know that story. You've heard through clients and transactions. So there's filler products that help bridge that gap and get them into a loan. It's a portfolio type loan that has a higher interest rate, but at least it gets them into the home now with the theory that they could, potentially refinance into a more standard loan later. Those products, for the most part, are gone. There are very few places even doing those right now. And some of the big servicers that a lot of us were selling those loans to have just completely suspended operations on a nationwide level. The good news there, though, is that doesn't encompass a huge part of the market. So it's as much as it's unfortunate they've gone away, it's not like that's a big piece of the pie, so to speak. DPA, probably the most confusing one. Every lender's telling you something different. Everyone's got different rules on it. There's no right or wrong. The reason it's confusing is because the big aggregator that allows these loans and has this program that all of us go to get them is still doing the DPA loans. So they never came out and said, we're not doing these anymore and we're closing our doors. What happened was, same story as I've been telling you, you've got lenders going, these are high risk products. Down payment assistance just screams high risk, right? A lot of these are lower FICO scores, not all of them, but a lot of them predominantly are. They're at a higher rate of default statistically because they don't even have the money in the bank to buy the home in the first place. So that's why lenders have said we're pulling out of these products. But they are still going and you can still get them. It just depends on who your lender is. And again, you want to reach out and ask those questions. Standard purchases. So really the only major change we've seen in just your standard normal mortgage, so to speak, if there is such a thing, is Chase Bank had a big announcement that said that they are going to 20% down and a 700 credit score on their transactions nationwide. That's a pretty big announcement when you can consider that you could do a 3% down, sub 640 credit score potentially on that product previously. Now that's just one bank, but it just goes to show you that some of those changes have been made. But at the aggregator level, or where I would call Fannie Mae and Freddie Mac level, there really haven't been significant changes to those standard products, which is good news. The other big change that was announced, just to give you guys, an example of big banks making big moves. Wells Fargo announced a few weeks ago that they were going to stop taking jumbo loans on the wholesale side. Wholesale is like working with a VIP mortgage, right? We sell these loans to Wells Fargo. They came out and said nationwide, they're not going to do jumbo loans anymore on the wholesale side. I also saw that Wells Fargo on the retail side, which means you're walking into their branch and, talking to their teller about a mortgage. To do a jumbo refinance with them, you have to be an existing customer and have $250,000 in the bank. So that's a pretty significant change. So just a couple things, give you an idea of kind of what's happened.
Absolutely. And I think those all really show exactly what you said, Stuart, that lenders are being very cautious to minimize their risk, really for the long-term sustainability of the company. So we're seeing that affect the consumer a little bit with some of these programs, but hopefully that will keep our industry healthy. Next thing is rates. And there has been, a lot of change with this. So I'll let you hit on it, Stuart.
Okay. This is always the $1 million question in our business, right? No matter what's going on in the market. The chart here is just sort of showing over a 3-year period, sort of what interest rates have done, right? And really, the main thing here, guys, is rates are unbelievably low. They're almost at the lowest they've ever been. So, quick little history in the last few months. In the very beginning of March, we saw rates dip to essentially the lowest they'd ever been, and then as soon as they went down, they went up just as fast. There's a lot of reasons for that. One of the main reasons is it opened up a massive floodgate of refinance volume that all lenders took on. And that inundation of volume is something that you can't really prepare for, because these are unprecedented market moves, right? So when you can't prepare for it, lenders just have to do their best to work through the volume and get to things as quickly as they can. But you kind of had a perfect storm happen with an inundation of volume into the system, as well as just not being able to do normal mortgage loan processing functions as quickly as typical, because there's a lot of third parties involved when you get a loan, and everyone from the title company to the appraiser to an insurance company, I mean, you name it, to verifying employment with someone's HR department. Everyone is now slower, or was to an extent, in getting back to us because of the COVID situation. So all of that combined created this perfect storm where you literally had banks shutting down their secondary pricing desks, which is kind of where they control the pricing and do all their lock commitments. And what I mean by that is if in theory, VIP Mortgage sent a rate lock in, they may have just kind of temporarily shut their doors down and said, we're not taking any more locks today, because they got so many, they couldn't even handle the volume. So what big servicers and lenders do to help mitigate volume and manage capacities is they actually purposely don't let their rates go down further. And in some cases, they turn their rates up to prevent and to ward off new loan application for a small period of time. But more of the point being that one of the big positives here is rates are now back down off of the kind of highs they shot up to in mid-March. And that we're now seeing, the average 30-year fixed right around 3.25, 3 3/8. If you're buying discount points, I mean, there are some cases you're getting below 3. So the big question I get all the time is, what do you think rates are going to do? And of course, I'm going to tell you that I don't have a crystal ball, and I wish I knew. And if I did know the answer to that, I probably wouldn't be recording this Zoom call. But I can tell you that I was listening to something very interesting, actually, just today. And if rates were to go much lower, the financial system really can't handle that. And I think there's a really good argument for that. As much as we want to say the COVID situation is going to maybe get worse, or the after effects, the ripple effects are going to be terrible for 6 months to a year, that should keep interest rates low, which I do think is true. But you have people that think they're just going to come drastically lower. And I look at rates and go, gosh, 3.3%, how much lower can a 30-year fix possibly go? And this argument that I heard was very good for why rates really aren't going to go lower, because the system, A, couldn't handle it, and B, it would be such an abnormal market that it would just be bad for everybody, as weird as that might sound, if you're the consumer wanting a better interest rate. So I think the point I'm trying to make is we can't predict what's going to happen tomorrow, but we can look at history, and I can look at all the charts and know that this is about as good as rates have ever been. And if I'm going to take action on a refinance or a purchase and it makes sense for me, now's the time to do it, because this is a window of opportunity. And I do personally feel like windows open and close pretty quickly. So that's good news.
Absolutely. It's been great news that amidst all the chaos and change that's happened, it is still a great time for buyers in the marketplace, because they're able to get in historic low rates. So it really, is keeping buyers in the market, and that's a great thing for all of us, all the agents and lenders out there. So yeah, we'll be curious to see what they do, but that's a great recap, Stuart. Thank you. And the next magic question that we get on a daily basis is, where do we think lending is headed? And there's been a lot of speculation about that. A lot of people have come out, and some of those headlines we showed you guys earlier, that it's going to be tougher to get a mortgage in the future. And really, we don't know. As Stuart said, we don't have a crystal ball for that. But we do know that some of these lending changes are going to be temporary, and things should normalize when we see some major recovery in the financial markets. And that's something that we can all, keep our fingers crossed that things do normalize a bit sooner rather than later.
Yeah, agreed. And I think that, you know, this chart you guys see right now, this mortgage credit availability, the reason that we thought it would be cool to show you this, I mean, I don't know if you're like me, but I'm a visual learner. And when you look at this chart and you look at just, all you're looking at is that steep drop off at the end of that graph, that is literally how quickly mortgage credit availability changed. And what that means in layman's terms is that's when all these products started changing. They started getting yanked out of the market. Liquidity went away, right? The investor demand for buying mortgage-backed securities and these types of instruments went away. So that just shows you over the course of, I mean, that goes back to 2012. There isn't a single point on that chart that looks anything like that, jumping off a cliff right there. So yes, that all sounds like bad news, but in terms of where's lending headed, we don't know, of course. But what I do know right now is that cliff that you see on that chart, that already seems to be plateauing to an extent, meaning, we've been on our toes in our industry on a daily basis since all this started going down, right? Waking up being like, okay, let's go, put the battle helmets on. What are we going to get hit with today? Who's going to throw what grenade in my office today? And it felt like that every day. In the last week, and I'm just speaking my own personal experience, I'm getting less and less grenades getting thrown into my office on this topic. So we're seeing that a lot of these knee-jerk changes have happened. I'm hoping that we're starting to see some light at the end of the tunnel as far as any future changes happening. Of course, we have no idea. I can't sit here and tell you there's not going to be any more changes. That would be irresponsible of me, because that could happen. But based on what we see today, it looks like that's starting to slow, and that I'm hoping that the current mortgage picture that we're dealing with today in terms of products and what's available to be, getting people into homes, is kind of what our new normal is until this all goes away. And we all would love to think that once this COVID thing kind of the golf ball gets to the proverbial hose, that everything's going to get clicked back on, right? Chase is going to say, okay, you can go back down to a 640 FICO score. And Wells Fargo is going to say, all right, let's start doing jumbo loans. And that would make sense, but I think there's a reality to it may not happen that quickly. I think things need to get through the financial system, and these banks have to make some decisions, and then that takes time. And so we don't know what's going to happen. But one thing that is good is because of all the inundation of volumes that we talked about on the last slide for banking, the banks are healthy right now, at least when it comes to the amount of mortgage volume coming in and what they're dealing with. So that's a very good thing for all of us, because that keeps that sector sort of humming right now. And we need that as an economy. So I think that's a good thing.
Absolutely. I think that was crazy that a lot of mortgage companies had record months for March that we'd never seen before. A lot of that was due to the refinance boom, but I think the low rates are keeping buyers in the market, like we said. And with things starting to normalize, hopefully business will continue at the same rates as we said, Stuart. One thing I did want to touch on in this graph here is that it shows a decline in 1 week of 16%, but that is not for the average consumer. The majority of the products that were removed, as Stuart said, were the niche products that really don't affect the average consumer. Those non-QM products, the jumbo products, and some of the others. So, and if you look there, it was really only a 2.7 decrease in the standard product, standard vanilla loan, as Stuart said. So that makes clarity of that chart a little bit there. And as always, we are here to answer any questions that you guys may have. We do a weekly lending update once a week. You can check it on the My Home Group calendar. Stuart tells us about all the new changes for the week. And in the meantime, we are always available. So feel free to reach out to us via email or phone, and we're happy to answer any questions on things you may be hearing about products or programs or changes in the market. And we do appreciate you listening to the video. We give you definitely praise that you are wanting to stay educated on these changes, because that makes you a better agent. And we're here to help you guys close deals on time in this ever-changing market.
Thank you guys for listening.
Yes, thank you. Have a wonderful day. Bye-bye.